Hi folks, it's Aidan, CryptoBirb speaking. Welcome to today's Friday webinar. Straight and beautiful greetings from Ericeira from Portugal, beautiful ocean, seaside city, a beautiful surfing town. Well, the vibe is here amazing. And also it actually definitely reinforces the feelings from the market because you get to cheer up whenever Bitcoin kind of like elevates better and higher. And that's what we've been looking on for the past couple of weeks. And well, the question is, as we are heading into the FOMC decision and into February, which historically have been historically bullish on the record, what is going to happen to Bitcoin, to stocks, to other markets? Because it's all cross-related. We're going to figure out this in a moment. Make sure you stay tuned. We're going there right now. Welcome, welcome, welcome. Let me know, everybody, how you guys are doing today. Again, it's CryptoBirb, Adam, speaking to you straight from Portugal. And let's have a talk today, shall we, about Bitcoin and whatever is going on the legacy side of the markets outside of crypto world. Well, the first thing to understand is, well, this is something that I come across pretty often, is that, well, technical analysis doesn't work, that seasonality patterns don't necessarily work, right? So if you claim so, if you believe that technical analysis doesn't work well, which has been he's having a historical record on the momentum investing side as well, and the overall existence of momentum in the markets, which drives the technical analysis and empowers it to exist. This has been the record of 212 years. This is the longest the records in the financial markets known, and this is the very base of technical analysis, right? Price has memory. Market technicians claim that price has memory, right? So it kind of like remembers what was happening the day before, what was happening a year before, let's say, right? So that the prices are not random. They're not random walks, so that each and every single time you kind of like, move without any sort of like interconnection. Well, and as the reality shows, the markets tend to trend at times whenever they break out of the noise that consists of like 70-80% of the time on the timeline of some noisy oscillations that necessarily are not constructive. And once in a while, such longer tails in a market appear. And when they appear, the definitely conditions are, to persist, right? This momentum principle makes this trend to persist in the direction of the breakout. And if somebody just comes, if you come across a person that tells you technical analysis doesn't work, you can easily ask them if they are going to bet on the negative summer temperatures, right? Because if there is no correlation on what happened in the past and what's going to happen in the future, there is like no connection, there's complete randomness, then, well, nobody knows the future. Then why not bet on negative temperatures in summer, right? Maybe it doesn't matter that for the past 1,000 years, the temperatures during the summer were positive or so, right? You never know what's going to happen in June. Yeah, so you cannot predict that the temperatures are going to be positive, right? So this is just putting it in the language and in the thought process, in a way of thinking of those who claim that technical analysis doesn't work, right? In the same way that you cannot, of course, predict and then forecast, what's going to happen in the next couple of months. You cannot tell the exact point, the perfect temperature that is going to happen, in the next months. You can still probably claim that there's going to be a little bit better better profitability in betting on positive temperatures during the summer, such as positive price movements, whenever the bull market kicks in, whenever this breakout appears on the Bitcoin and other markets, right? So there are certain phenomena, there are certain price movements that are dependent on seasonal effects as well, right? And just like the weather oscillates and temperatures oscillate because of seasonal, effects during the year, they're like 4 seasons for many places. Similarly, gold likes to ascend towards the end of the year as people buy in jewelry for the presents, right? There are certain periods where for Q3, which is typically where people take vacation and time off, they would not necessarily trade so much. So the volume decreases and the market is less likely to decline at that time. Yeah. So there are certain patterns that, despite you cannot predict the future with 100% guarantee, that you can still, based on very valuable data from the past, to draw conclusions that can make you money. And that's the entire point, right? So if we go there, I would argue that we're looking at one of the most important charts. That's the way I framed it. This is the crypto breadth, which shows you this overall across the entire platform, the strength of the market as in 200-day moving average, right? Trend, you can tell that it definitely just inclines a lot towards the right side of the picture. And what it means is, well, that there is a significant and substantial improvement in the way that the entire crypto market performs. Because this shows you the percentage of crypto assets above their 200-day trends. 200-day simple moving average is basically what we call a bull market or a bear market trend. This is the primary trend representation. So this basically tells you that about 30% of the coins out of the entire crypto market are in their own bull market, or are in their own bull rally, if you will, above the 200-day trend, which had been declining for the entirety of 2022. So those are substantial changes, and you can tell that there is the significant spike from well, the first days of 2023. We were at the level of 5% of crypto coins, right above 200 AMA, and we've multiple, with quadruple or quintuple, whatever you name that, I don't even know, 5 or 6-fold just literally pumped towards 30% or even beyond of the coins, right? So this is a very distinct improvement, very substantial improvement in the way that the crypto market as a whole just shows. So of course, again, there's no guarantee it's going to continue like that in the future. However, it tells you that there is a little bit of optimism and hope to be introduced potentially among many traders. I hope it makes sense so far. Please let me know, guys, if you can hear me, if you can see me fine. I do hope that all the qualities remains pretty cool enough. So if we go to actually just put Bitcoin into context, you have to understand what is going on outside of the Bitcoin itself, right? So we're going to have a look at the Dow Jones Industrials chart, right? So the Dow Jones Industrials, you can tell that it's basically why it's not showing. Let me close this again and open up screen version. With the new updates from the Mac, something strange happens. Anyways, well, the Dow Jones Industrial, the industrial average of Dow Jones, basically, is moving sideways after breaking above the 200-day trend at the end of November, right? So this is a significant breakout level that, that was broken at that time at 32,500. And ever since the breakout, we were kind of like moving in this a little bit of elevated ascending direction where the disparity between the long-term trend and short-term trend kind of like increases. You can tell there is this gap inclining gap that tells you that the short-term and medium-term momentum or trends defined by the 20-day and 50-day average are moving better and higher and more distantly, with more distance, well, to the 200-day trend, right? So it kind of like shows you a little bit of a jump, outside the long-term or the previous declining tendency of 2022. It's a positive sign. And ever since the breakout, it's moving within the frames, right? Within some sort of like a range-bound type of a movement between 34,500 approximately and 32,500, which has been the significant breakout retest level, right? So more often than not, the moving averages are a good source of anchor, of psychological anchors. Many traders tend to anchor and place their attention, frame their mind somehow, to assess that support or resistance is going to be found at certain moving averages. And the more eyes look at the same averages, the self-fulfilling prophecy effect is going to basically make it work even better, right? So the basic set of averages is 20-day for the short term, 50-day for the medium-term trend, and 200-day for the primary trend, long-term bull markets or bear markets. So right now we've escaped the bear market of 2022. We are moving slightly with definitely less aggression, still slightly climbing and taking very tiny steps, to the downside. However, with this overall sideways horizontal manner. So it tells me that the market has shifted. Market has shifted technically inside of it, right? There's something that the forces have reshuffled inside of the market. And if we go further and take it to the S&P 500, we've seen this significant break and a follow through higher with a close towards the high of the day, on the S&P 500 index, right? So this is positive. Even though we are printing a little bit of uncertainty candle, right now there are still, of course, some hours to close the market for today. S&P 500, you can tell there's a little bit more aggressive decline as the overall prices direction were more downwards oriented for the entirety of 2022, and we are still we can confirm or suspect that this overall 200-day average trend may be a little bit less convincing than for the Dow Jones Industrials, right? Because if you compare the angle, right, here it's a little bit more, horizontal. Here it's still kind of like under the effect of downward movement. So the way I see it is, well, that this provides a little bit more headwinds, right? Because if the long-term narrative, the dominant tendency is downwards oriented, and we kind of like slash and move higher, this moves counter the main trend. So this is considered a little bit like a counter movement, a little bit of a corrective movement, at least until we finally break and reclaim the 4,100 level, right? This is the most substantial resistance, which right now, once reclaimed, will confirm eventually that the new bull market has started for the S&P 500 stocks, for the large caps. And if we go further for the S&P 500 sectors, what it tells me is, first of all, we see certain clump of negative performance sectors and the ones that are positive. And the positive, the main outlier on the top is basically represented by the communication services. Yeah. So the communication services are the leaders with 14%, 14% year-to-date return, which is positive, which is strong and sharp. You can see there's a lot of consistency on the way up. However, the ones that are underperforming, let's have a look. Those are the healthcare, which is defensive. Those are the staples, which is defensive. And those are the utilities. So the way I see it, the 2023 has kicked off and so far sustained this overall movement counter to the direction of 2022. It's a substantial shift, technical shift. What's happening inside the market has reshuffled. The forces have changed the side of the balance. And you can tell that the risk assets, such as communication services, then subsequently led by this consumer discretionary, which is cyclical stocks, they tend to move along with the cycles and empower the market cycles. So this tells me that there is this leadership from the risk on assets, right? Versus this overall deterioration on the way that the risk of assets, as in healthcare, communication, healthcare, consumer staples, or the utilities are performing, right? So this tells me that the risk appetite of the traders for 2023, because the price trends are forward-looking. It's what traders imagine to be the future now, right? It's the prices are driven by the expectations of the future returns. This tells me that the traders are more optimistically looking into 2023 than they did for the entirety of 2022. And it's positive. There's clear distinguished difference between the risk side of the market and the risk off markets, right? So this is positive and potentially, promising for the Bitcoin movements as well. Hope it makes sense to you guys. Please let me know. If you're watching that on YouTube, make sure you hit a like and hit a subscribe button as well. Drop some comments, drop some questions if you have any, and definitely make sure you hit the notification bells because we've got too many videos coming up this year for you to miss it. So don't miss out on that and protect yourself against many, many impersonators as well. This is the only alleged account that we have on Twitter and on YouTube, right? And there are so many impersonators. And there's lots of people that definitely have not been necessarily satisfied with what Elon Musk has been doing with Twitter. I understand that. I dig that. So make sure you are protected and protect yourself with following us on our Twitter accounts, as well as hitting the notification bells and subscribing to our YouTube channel. If we go further down the rabbit hole, what we can see is that the energy market is kind of like moving. This is the XLE, which is the energy sector. It's still outperforming the S&P 500 relatively. So the relative strength, as you can tell here on the upper right corner, is still kind of like elevated, right? It's still on a definite bull trend. However, it started making this a little bit of, I would frame it as a maybe bearish divergence, if you will, if it makes sense, maybe, right? I would call so because there's been a slight tiny decline. I wouldn't bet my portfolio on that, right? It's just purely an observation that while the prices of the XLE, have kind of like just, almost equaled the peak of December at 93.74 per XLE, there is a little bit slightly more visually at least, aggressive decline on the relative strength. So just maybe it may confirm that ahead of the price, which it often did, like it did in the past to inform about the breakout, before it actually happened, it has this preceding forecasting power and force. Just maybe it shows a little bit of a slowdown, right? Which is of course seen at the trend and that it's shifted, basically moving sideways right now. However, the context is that it's moving within an overall primary bull market as the 200-day trend ascends and continues to ascend, right? With a support at 80.42. Well, this creates a little bit of space for a range-bound type of a movement, right? Until the breakout to the upside follows through. Then my suggestion or my expectation is that until we see this factual breakout, which may never come, for instance, we would probably move a little bit within this range-bound type of a movement. So oscillation a little bit. The reason I say that is because we have a support at the 80.42, and for the same reasons, the long-term primary bull market average, 200-day average, provides a significant strong psychological anchor for traders to refer to as what the fair price of the XLE fund is. I hope that makes sense, right? So what's important is that we are right now seeing this a little bit of shift, like I said, as the new trend in the 2023, the bull market kind of like seems to be kicking in, right? This is definitely not bearish. This is very bullish. I would say that the risk actors, risk assets, risk agents there, are basically moving higher and accelerating quite nicely. Whereas the defensive side of the market is really pessimistic in terms of the expectations of the traders. Well, then what I would argue is definitely a caution signal is that the energy prices remain elevated, and until you see the significant breakdown below 80.42, well, the energy works. The elevated energy prices work like a hidden tax, so that they drain money out of your pocket. They take your disposable income that you can spend on anything that you want, including investments in the financial markets. This takes and drains the money, through this pipeline, and well, basically not letting you to invest more, right? Which is why the markets are a little bit held back. So the moment that it breaks down, which is likely going to come and align somehow with the Fed's decision for the FOMC committee board to start or to cut, stop basically hiking the rates, right? The moment that they start decreasing the rates, historically have been a good signal for the bull market to kind of like unleash the full speed and the full force. Another good confirmation for the risk side of the market is this relative strength ratio for the XLY, which is consumer discretionary cyclical stocks driven by the market cycles, as well as consumer staples, which are kind of like irrelevant or independent on the market cycles. They just move regardless, right? Because of their stability, because the consumer staples are the basic needs goods, right? That you should have, so like beverages, clothes, and so on. While consumer discretionary, like cars, anything that regards your discretion, your opinion, whenever you can afford it, that's what you do. That's what the stock market for the XLY just inclines. So we are looking at this violation and this failed breakdown, and a follow through higher, for the XLY, which is inclining trend tells me that one is outperforming another, that the XLY, the consumer discretionary, are pumping and outperforming the XLP, which is something that we've seen in this performance chart overall in a couple of seconds ago. And the moment that it breaks through, right, the moment that it breaks through above this 200-day trend of 2022, this is a bear market trend. So technically speaking, from the technical viewpoint, if the risk assets outperform the consumer staples, the basic goods, with such a powerful break above and violation of the 200-day trend, of the long-term trend, well, this confirms this internal shift within the market. This confirms this overall shift and change of the forces, this rebalancing, shift, shuffle, reshuffle inside of the market that is happening, right? So right now we've pulled back, we've validated this failed pattern, this failed breakout at the bottom. And all I know is that the failed breakouts tend to perform better in the opposite direction, because not only they gain on the momentum, but they're also force all the other traders in the losing positions out of water to cover for their shorts, to cover for the positions, and also empowers the FOMO, fear of missing out, for the regret bias, recency bias, cognitive dissonance, and so many other mistakes and errors. So this is a positive sign, and while it's right there at the resistance, it's reverted back to the mean. So as long as you get to, look at the consumer discretionary below the 200-day mean, it's not fully unleashed, it's not fully confirmed. However, the moment you see this breakout and retest this reclaim above this long-term primary dominant trend, then this is a historical shift and something that is most likely going to empower and reinforce the bullish action for 2023. Funnily enough, this is maybe something that I hadn't mentioned, so far on the webinars, on the streams. 2023 is a pre-election years, as a pre-election year, and in the 72 years of the past history ever since 1950, this has been an excellent year on the card, on the record. So this has been the strongest of the entire 4-year presidential cycle, the strongest year, on the far contrary to the midterm election years, which was 2022, which tend to extend the bear market, or at best return sideways returns. Yeah, so nothing except for the break even. So on the far end of the spectrum, we've got pre-election years, which is 2023, and those tend to be the strongest pumpers, the best performers on the record ever since 1950. This is not some sort of like gimmick, one-trick pony, just like I said. Some people could argue that the seasonality in the trends doesn't exist, but if there is over 80% accuracy and repetition in repetitiveness in this formula application, right? That 2023 as the pre-election year, and all the pre-election years except for some exceptional cases have been performing well, then it could be used and should be used as a means of setting up the expectations, right? Because just like I said, although you cannot predict the future temperatures in the summer, well, would you bet against positive temperatures? Would you bet on the negative temperatures? Of course not, right? Unless you will love losing money. So the same way, if you have high certainty and high probability, like 80% historical records over 72 years of data sample, telling you that the pre-election years are strongly positive, are the strongest performance of the entire presidential cycle spectrum, then I would argue it would be unwise to ignore that, right? So take it with a grain of salt, of course. Everybody should decide about their own relevance for it. What I mean as well is that the bonds are, looking somewhat positive. The return back to the mean, the bonds are positive, right? Because they are inversely correlated or negatively correlated to the yields, to the interest rates. So as long as the Fed starts, reducing the interest rates and buying the bonds to their balance sheet for the securities, well, buying increases the demand, which is definitely what improves and inclines the prices. So eventually, when I see that the government and that the Fed, the monetary policy, starts buying back bonds, on a regular basis, and or at least stop selling them, right? Then eventually we may see the 30-year USB bond long-term maturities break out, and this could be definitely reinforcing and promising for the risk assets as well, for the stocks. Otherwise, we are kind of like looking a little bit forward for the next 6 to 9 months with a negative expectation in terms of the business, right? Because we get to see often that the business cycle, which is the economic cycle, the way that the economy performs and moves, GDP and so on, is lagging 6 to 9 months behind the financial markets. So the financial cycles, kind of like stocks, cyclical stocks, just like consumer discretionary, technology, communication services, industries, which is something that started inclining and rising very well recently. So this makes me think that we are somewhere on the model, on the inclining curve towards the, in the bullish direction of the financial cycles, which eventually will also empower the economy to turn up. However, right, it doesn't mean we are done with the economic decline, right? Because this typically happens that from the moment that the Fed inclines the or hikes the rate, inclines the rates, raises the rates, it takes some time until the economy, this huge, monstrous firm as the one as the country is, just starts reacting to it. And the bigger the country, the longer the time until it starts reacting to the rate hikes like that. So I would argue that it's positive, right? That we are looking at this financial cycle, financial market kind of like inclining already. And this tends to align with the final phases of the declines on the economy side, right? So probably we are yet to see the economic extension to the downside and contraction, further contraction of what we know a recession, right? And the best signal historically has been to watch the interest rate spread between the 10-year maturities and the 2-year maturities interest rates. Yes, the yields. So, and ever since 1980, we had not really had such a deep yield curve inversion. So yield curve inversion, inverted yield curve, negative interest rate spread, whatever you name that, has historically been an excellent indicator of the economic recessions, right? Each and every single time, it actually just elevated the disparity and just declined, just plunged like heavily below the zero breakout or the zero break-even threshold, Well, but this tells me that this disparity on that the Fed is basically, keeping the short-term yields, which is the 2-year yields, that they affect Fed's monetary policies kind of like just acts on the shorter term maturities, right? And the prices and expectations of the investors just correspond mostly with the longer term, longer tail, a longer side of the yield curve. So this tells me that the economic forecast is not good for the next 6 to 9 months. So probably we may see a little bit of incline in the stock markets the way I see it, right? Incline in the stock markets, which at the same time, probably just gives a lot of inclines for the risk assets, which cryptocurrencies are, right? Cryptocurrencies are, very often considered by the institutional investors as some sort of like a risk barometer, right? Like a risk appetite measurement. So I would argue that it's positive overall for the next couple of months. It may happen that we're going to have this sell and may go away type of seasonal pattern. That's what I probably would do personally, to wait for the quarter three and then probably to encourage and reinforce the full alignment of the economy, right? The moment that the strong full alignment of economy with the stock market, with the financial market. So the economy the bull market is fully unleashed. The bulls are fully unleashed when there is a full perfect alignment in terms of the directions, right? So inflection point on the economy starts here. It starts turning up. It starts expanding again, right? Buying on the balance sheet and so on by the Fed. And you get this short period that the stock market and the financial cycle improves, and at the same time, the economy improves. So one kind of like empowers another. So this is where you get to see this exponential trends much more often than not. Yeah. So I would expect that something like that starts happening towards the end of the year, maybe, right? A little bit of sideways, but it's overall strongly positive on the record. That's what I would expect. And just this recessive signal that is not willing to come off. It's staying here for a long time already. It's really staying here for like many, many months. So it's not healthy. It's not constructive for the economy. I would argue that this may take basically, just, hostage, up here. So long story short, again, we are looking for this inflection point on the economy. And the moment that it starts inclining and both incline, this period that both financial cycle inclines and the economy inclines, expand, this is where this biggest biggest rallies are. This is where the biggest bull markets are, right? So we are looking to see, and then, this start of another cycle of expansion for the economy, and at the same time, the full alignment in terms of the direction and the growth for the stock market and risk assets such as cryptocurrencies. So the moment we see it, it's definitely going to be much more constructive. And this is where we would most likely see these very full blown out bull markets. That's the way I would expect it, just maybe to start towards the end of the year. Otherwise, February, has been historically good on the records, right? The cumulative profit over the past, 12 years, basically versus 2010, has been positive, right? Only 3 out of 12 times, since 2011, or the first February on the record, which is 2011, we're looking at negative returns during February, right? So buying in February or negative February, so it had only been a minority of the cases, 3 out of 12 times. This gives a substantial 75% of chances, historically speaking, right, that February is going to be positive. So again, is this, despite we cannot predict the future, is this something that you're willing to bet your money against, right? If there are 75% of the chances historically in the past on the record that February was positive, right? And even though there are still headwinds on the economic side, contraction and for recession, just maybe, and so on and so forth, the high elevated prices and the Russia-Ukraine war, then even though, or in spite of all that, would you still bet on negative February prices, right? With the 75% of the chances that you're going to be wrong. Well, risk seekers are probably going to take it. However, if you weigh in on your money and you care about your money, you will probably try to allocate your money to whatever is likely, right, to happen. So, long story short, it's been overall historically good and positive, with 9 gains and 3 losing instances cases, to invest with February or in February, during February, with the annualized return of around 520%, if you will. So knowing that the odds are historically positive for February, right? How does it translate to Bitcoin? With strong correlation coefficient on the 7-week basis to S&P 500, it tells you that there is very strong, max is 1.0, and here we're looking at 0.98. This is an extremely strong correlation and attachment, relationship with the stocks of Bitcoin with the stocks. So whichever the direction for the stocks are going to be taken and expected by the traders, Bitcoin is likely to follow, and vice versa, right? That's the other way around as well. So 0.98 correlation on the 7-week basis, medium-term basis, tells me that the traders are considering stocks back again on a similar track or within same type of movement, same type of acknowledgement, recognition, just as they would for the S&P 500. So this builds up a lot of technical reasons for the markets to behave in a similar manner, in a similar way. So besides, if we have a look at the long-term basis, long-term perspective, I would argue that, well, we are looking at a very substantial signal. Every time there was the significant burst outside the 200-day average, no matter there were kind of like declines on the way, but every time after heavy declines after bear markets, right? We've got like 4 bear markets ever since the record kind of like started. So each and every single time we've seen a breakout outside the 200-day bear market trend with a follow through, right? Regardless if it happens already immediately or after some sideways, the first substantial breakout outside the 200-day trend eventually initiated a new bull market, right? So that's the type of a record that I'm looking at. And we're looking at the same picture here, right? The substantial breakout above the 200-day trend. Of course, there is no guarantee it's going to exactly the same behave in the future. However, again, is this something worth counter trading, right? If the signals that happened every single time before the new bull market started or kicked off with the full power, and the same signal you're observing right now, is this worth betting against? That's the type of a question I'll definitely leave you with for your own consideration. Otherwise, Ethereum is fairly strong, right? It's fairly strong. It's looking at the same levels than November highs, similar to Bitcoin, or Bitcoin is even actually outperforming that, right? So November highs are kind of like measured and equaled by the Ethereum versus USD. However, Bitcoin has outperformed, this relative to its own prices. Of course, there's a little bit of change in different outlook perspective to what Ethereum prices and Bitcoin prices look like. However, Bitcoin relative to its own price history has outperformed when compared to Ethereum. Right here on the bottom are ATR volatility indicators that are often adjusted and seen within the Birb Pro setup. However, long story short, the most important point is that we've started inclining and ascending on a 200-day trend. So the long-term trend has started ascending for the first time in a long while. Same is going on for Bitcoin. This is positive. This is constructive. And for our chart on Bybit here, is showing you definitely a lot of chop, right? Local chop with a whipsaw on top, and this kind of like a failed pattern. This failed pattern on top is not the most constructive, so I would argue that probably we may see a little bit more downside locally, until we really break it and validate this outstanding wick. to the upside. Yeah, this one needs to be reclaimed with a follow through higher on the next day, kind of like just also following through higher to validate the breakout, right? It's until that happens, Bitcoin is kind of like on the selling pressures and on the selling forces. So I would argue that again, until we get to see this proper reclaim to the upside, we may see a little bit of a range-bound chop, range-bound sideways movement that eventually may even take us lower towards like 21,500 or even take us lower. Yeah, take us even lower towards the 200-day trend. Basically, mean reversion, if you will, right? So if we have a look, this is typically what's happening in March, right? March typically, gets, well, let's have a look. First March, is buying in March a good decision towards the 1st of April? I would say that there's like, bigger chances are that March is going to be declining 7 to 5, right? So there's 7 to 5 chances that the March is going to be historically negative. So just maybe if I were, to comment, maybe we may see a little bit of chop, throughout February, maybe even go higher. We still have this overhead resistance at $25,000. However, eventually the mean reversion is likely going to happen, right? So until the 200-day starts inclining, we definitely are going to see some moments, periods where Bitcoin continues or moves back, retraces back, reverts back to the 200-day trend. To the upside, to unlock the $25,000 resistance, I want to see first a significant breakout over $24,000, which may immediately just follow through with 25K. Otherwise, a break below the stop threshold defined by the Burbicular Pro high time frame trailer, below 21,900, right? So a break below 21,900 is going to reverse this trend, at least, or give a warning signal to move back to cash, to crypto, well, to stables or whatever, at least to my strategy, to my personal system, right? In order to protect the capital from losses. So I've been riding Bitcoin with my high six figures quotes, for ever since 16900s, right? That's where I got this bull notice. I've been riding it. The trading stops higher all the way up until 21,900. And that's my guaranteed kind of like a profit return, right? Right now, Bitcoin is kind of like just moving sideways. If you can tell, if you can switch it to the linear chart, right? Then clearly you can tell there's sideways just like it was in here or like it was in here. And that's normal because for most of the time, cryptos and other sites and other markets just move in sideways. 80% of the time is this chop, and only 20% or 30% of the time kind of like moves in this sharp exponential trends to the upside or to the downside. So just looking at the candlestick outlook, right, with the Burbicular Pro on, right, this is my personal trading system that I use on the 12-hour time frame. Well, then I would argue that as long as this 21,900 is defended, well, that's where right below my stops are, right? So as long as I keep trading it, as long as it keeps breaking out, I will just continue to trail my stops higher. And that's the way I ride the trend as a trend follower. I hope it makes sense. And gents, listen, it's been an excellent session to be sharing that with you. Thank you, Michael Maguire, for very kind words. Thank you, Siran, as well for your comments on the dropping alpha. Doing my best for you, lads. You're here. You've been here for a long time, so congratulations. Kudos to you. And before I disconnect, I want to give you and tell you about an offer that we have got. Well, because definitely I love the fact that I can give back to the community. And in order to give back to the community, we've got our special offer. We're in the partnership with our partners with Bybit. You can acquire our calls only program with signals, with premium calls, something that had never been freed up to the public, for free. And you can get this for free for a month, for 4 months, or even for an entire year. And the entire year costs $1,428. Right, so almost $1,500, almost like above $1,000, almost $500 above it. It can be given to you for free. That's it. So if you want to basically invest in your knowledge, paying round zero quote for it, right? If you're interested in acquire this offer, just make sure to head to theburbness.com/COBB, right? Theburbness.com/COBB. Type it in. Go ahead, and unlock your free membership within the calls only world. And the Burbness is counting 6 years already. This is the 6th year that we are acting, and the calls are only improving. Make sure you stay tuned for more details. Go ahead and tune in theburbness.com/COBB. I see you there, and I hope you enjoy our premium calls for free all year round. God bless you all. See you around, and bye-bye.